Alright, great, yeah. Let's start. Okay, so in the last class, what we did was we finished a practical example of ABC costing. Now, what we look to do is we'll finish the advantages of ABC over absorption, right? So, what was the primary difference here? ABC is based was what? Activities, whereas the absorption base was what? Production volume, absolutely right. So, that is why the two were different in those ways. Now we look into the advantages of ABC costing. Why is ABC costing better compared to the absorption method? Okay, so let's look into that. Firstly, we'll start with enhanced accuracy. You will see ABC is more accurate. Second, it helps managers understand the activities generate overhead cost. What are the activities that generate cost? It recognizes product complexity. There's a better cost control and you can apply it both in service and manufacturing. That is the best part about this. Okay, so these are the top advantages. And finally, ABC can allocate production, administration, selling, distribution overheads, all the overheads. That's the best thing about it. Okay, so now we look into the advantages, guys. Firstly, better cost, enhanced cost accuracy. You're more clear and more accurate about the costs. Second, overhead cost insight. You get a very good insight over the costs. And next, it recognizes product complexity. Even for different products which consume different resources, it gives them the respect. And it recognizes that certain products are complex. There's a very good cost control. You can apply it in service sector also, manufacturing sector also. And there's a comprehensive overhead coverage. You can allocate production, admin, selling, distribution, all overheads. So that is the biggest benefit of ABC. Okay, let's go through the first 3 year, more accurate, better cost insight, recognizes the products are complex and there's more complexity. It gives them that respect. There's a better cost control, universal application in manufacturing and service industries, both comprehensive overhead coverage. You can allocate administrative overhead, selling overhead, distribution overhead, production overhead, all the overheads you can allocate. Universal application, very good cost control. It recognizes that certain products are complex. There's an overhead cost insight, and finally enhanced cost accuracy. There's an enhanced cost accuracy over here. There is an enhanced cost accuracy. So you are more accurate, you are giving better insight, you are respecting the fact that some products are complex, then there is a improved cost control over here. And finally, there's universal application, manufacturing and services, both industry you can apply, and all kinds of overhead you can allocate, all kinds of overhead. That's the biggest advantage and that is the biggest benefit here, that all the kind of overheads you can allocate. You don't need to only have manufacturing, only the service, no, all kind of overheads. These are the advantages. Okay, let's make sense of the last 3 advantages here quickly. Monisha, let's go into this. Yeah, okay, yeah, all right, yeah, so yes. Okay, so managers can reduce the cost by controlling the activities that cause them. So if you know what money is being used where, you are able to allocate the costs accordingly. And if you know the allocation clearly, you know what is causing you the most expense. So your control is really good. And hence you are more accurate also. And the fact that recognizes all the complexity around the products as well. So these are the biggest benefits of ABC costing, which is a modern way of doing cost allocation, overhead cost allocation, right? The modern way. The old way was absorption. The new way is ABC. However, see, with all good things, there are some disadvantages as well. So let's look into the disadvantages over here. So these are all our disadvantages. Okay, when we talk about ABC costing, these are all our disadvantages. Let's make sense of the disadvantages. What about the disadvantages here? As good as the advantages are, as important it's important to know the disadvantages as well. Okay, so let's look into the disadvantages as well. So these are all the disadvantages. So when we make sense of the disadvantages, what does it say? The first thing it's telling us is that there is a limited benefit in simple environment. So see, the more complex, the better. You put it in a simple environment, there are very limited benefits. ABC adds little value when overheads are very low or productions are very similar. Doesn't really make sense that much to use ABC there. Next, ABC is more difficult to understand and implement than traditional costing, right? You obviously need to have an ACCA qualification or a similar type of qualification to make sense of this, and sufficient training time you have to give. Simply anyone cannot understand. Then some overheads cannot be linked to specific activity, like a CEO's salary cannot be fairly assigned to individual products. So some overheads just can't be linked. Then cost benefit consideration, ABC is very expensive to implement, so the benefit should exceed the cost. And then Yeah. So these are the limitations before we move on to the next thing here. Okay. Do we have some extra limitations? Selection challenges, yes. So choosing a incorrect activity or cost driver can totally produce very inaccurate cost allocation. If you've done a very incorrect cost allocation, that will be a problem. If selected a wrong cost driver, that will be a big problem again. So first of all, guys, in simple, no point. In simple businesses, no point. Second, if ABC is more difficult to understand for a person than your absorption costing. It's impossible to allocate some of the cost like CEO salary. Next, if your benefit is not greater than the cost, please don't do ABC. And finally, if you've chosen the wrong cost driver, then even though you've used ABC, still you'll get the wrong answer. Okay, let's make sense of this here, Aditi, quickly. Disadvantages here. Okay. 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 Yes. Very good. Hmm. Correct. Okay, so even if you're using the right cost, even you're using the ABC method and you're using the wrong cost driver, there's no point of it. Okay, yeah, guys, following. Okay, up till now, advantage, disadvantage, easy. Let's move on now. ABC in the public sector. Okay, what is public sector? Where government has some kind of a following, following in the sense holding. Okay, they have some kind of a percentage. Government has some kind of a percentage in the running of the organization. Okay, so why a public sector organization consider ABC? So as a public sector organization, why would you consider ABC? Okay, why would you consider ABC as a public sector organization? Okay, as a public sector organization, why would you consider ABC? Okay, ABC in a public sector organization. What is a public sector organization? Where government has a holding. Okay, where government has a holding, that's an public sector organization. So let's make sense of that. That why would a government sector organization consider ABC? What is in it for them? Okay, public sector. Okay, so let's make sense of the public sector here. Yeah, first of all, governments use ABC to improve cost control. See, ABC is such a good method. Why government like why should we not have the fun? Why should only private people have the fun? Next, so public organization must use limited taxpayer funds efficiently. They need to make sure that they're using the taxpayers' money. It's not their money at the end of the day. It's everyone who works hard and it's their money, so they should use it effectively. Use the best method that is possible. Next, public accountability. They are accountable for public's money. So if they don't know what is where they're spending, what is the proper cost allocation, then could be some frauds, and they can keep the money that belongs to everyone's development. Next, equitable resource allocation. ABC helps distribute resources fairly across departments or services. It leads to a very fair allocation of resources. And finally, enhanced management capability. Management of government companies or government influenced companies use ABC information to decide which services to improve or which services to reduce. So overall, these are the reasons why. Because see, you're using public's money, you have to be responsible to the public. You have to do it on a fair basis, and it makes as a manager, it's easier for you to decide which is adding value, which is not. Yeah, let's make sense of this here, Monisha. In public, in government companies where government has a stake, why is ABC preferred? Yeah, in companies where government has a stake, why do they prefer ABC? Especially in companies where government also has a stake. Uh, uh, yeah, yeah. Uh, Decide where is it efficient. Yeah. So at the end of the day, see, you're using governments, so you're using the taxpayers' money to, and enable services. So you have to make sure that you use the taxpayers' money really well. And ABC is best. You can't hide behind any costs unnecessarily. That is the reason, one of the biggest reasons why we are using the ABC, especially in public sector companies. Next, public sector implementation challenges. But in public sector company, there are some implementation challenges also. If we talk about public sector company, there are some implementation challenges that come with it. Right? It's not very easily implementable. Right? They're not very easily implementable. Right? They are not very open to change. Right? So what are the challenges? Right? If you if you're applying ABC in a public sector organization, what are the challenges that you may face? Okay, let's look into the challenges here. First of all, employees may oppose ABC because it increases monitoring, it increases accountability. Next, ABC, successful ABC requires employees to accept transparency and evidence-based decisions. Okay, these are the reason why it's not easy. Okay, let's make sense of this here, Aditi. Why is it not very good for public sector companies? Like why it's a little difficult to implement there? Yes. Hmm. Hmm. Perfect. It puts you under the scanner and you have to now you're answerable for everything, you're accountable for everything. And if that is the case, it becomes difficult. Right? If that is the case, definitely it becomes difficult. Okay, so that is about this. Let's look into the next part here, that is JIT and TQM. Let's make sense of this JIT and just-in-time accounting. Yeah, and you would have studied in FM. This is an important topic. It's a topic you see in the chapter of inventory, just-in-time, and total quality management. This is something that you would see in MA. So let's make sense of this JIT and TQM. What are we really getting to here? Okay, so this relates to that. So first we'll start with the basic understanding what it really means, both of them. Just in time and total quality management. Total quality management, I think you've got a gist of it just by reading it. That's a management approach focused on producing high quality products through continuous improvement. High quality through continuous improvement. We're getting to high quality through continuous improvement. Okay. And just in time production, it's a production system where goods are made only when customer needs them. Reducing inventory. Goods are made only when customers need them. Just in time, what do? We make goods only when customers need them. In just in time, what do? We only make goods when customer needs them. Right? In just in time, what do? We make goods only when customer needs them. In total quality management, what do? It's a management focused on producing high quality products through continuous improvement. Right? A management approach focused on producing high quality products through continuous improvement. Right? Total quality management, it's a management approach focused on producing high quality products through continuous improvement. It's a management approach focused on producing very high quality products through continuous improvement. Right? Through continuous improvement, you're going to produce very high quality products. And just in time is a production system where goods are made only when customers need them. Right? It reduces inventory like a tailor-made shop, a shop where their clothes are only tailor-made, a shop where clothes are only tailor-made. So here you would see that finished goods will be very less. Right? It's a production system where you only make the goods. There's no ready-made here. There is no ready-made. You only make it when the customer needs it. You only make it when the customer needs it. You only make it when the customer needs it. You only make it when the customer needs it. Total quality management. Here what happens is you continuously improve, and you make very high quality products just in time production system where goods are made only when a customer needs them. You don't keep any inventory regularly. Whenever customer needs them, you make the good. Customer needs them, make the good. Customer needs them, make the good. Customer needs it, make the good. Okay, you don't make it and keep. Right, you don't make it and keep just in time, so you hold very less inventory. A car manufacturer order parts only when the production begins, else he won't hold the parts. He doesn't keep anything. Only when he needs it, he will get it. Okay, when only when he needs it, he gets it. Right, and now with 10 minutes delivery, you can definitely factor in that. And rather than getting anything, you just order it. It comes to you, and then you can just have it. Don't need to store and keep because the production has become so easier. Okay, so total quality management and just-in-time production. Total quality management and just-in-time production. Total quality management and just-in-time production. Total quality management, just-in-time production. Okay, total quality management and just-in-time production. Total quality continuous improve, and make a very high quality product just in time, where goods are made only when customer needs them. No ready-made, and you are not holding any inventory. Okay. Now there are some implications for cost accounting. What are the implications here? First of all, there is high automation. The modern factories, they rely heavily on machines and robotics. Overhead cost dominance. There are a lot of machine-related overhead costs. It's the products are made in small batches because based on customized requirements. The stock levels are very low. They don't keep much. Okay. So there's a high level of automation. There's an overhead cost dominance. First of all, there's high automation level. What is it? There is high automation level. What is it? There is a very high automation level. A very high automation level. Modern factories rely heavily on machines. Machine related costs are much higher than direct labor cost. Your machine related costs are much higher than direct labor cost. Then you make very small batches because you are making based on customer requirements. You don't make in bulk and you keep and then you sell. So low stock levels, you don't even keep much of inventory, right? So you have less storage cost also and less of your money is held up in inventory. Okay, let's look into some cost implications here, Monisha. What are some cost implications if you have a total quality management and just-in-time production? Yes, yes. Hmm. Requirements. Very good. There's very low stock levels, right? So you have to spend very less money on the stock, on storing the inventory. Okay. Now we look into throughput accounting here. Okay. Let's look into target costing now. What about target costing? Oh, sorry. Let's just throughput about that. Okay, let's go. Next, we look into throughput accounting. What about throughput accounting? It's broken down into very around nine simple ideas, pretty much, not much. Okay. So we're looking into throughput accounting here, basically a costing method that focuses on making the best use of the bottleneck. What is the bottleneck? Scarce resource to maximize profit. So use your scarce resource as well as possible. What is the bottleneck? That's the scarce resource. You use it as well as it's possible. Right? It's improve the profit by making the best use of the existing resources without increasing the capacity. In the short run, only direct material cost is considered variable. So here in the short run, you only consider the direct material cost as variable. Direct labor is treated as a fixed cost because employees are usually paid salaries on guaranteed wages. Throughput is similar to contribution, except only that direct material is deducted from sales. So here you even deduct the direct materials cost. Okay, let's first clear the background. What is throughput accounting? It's a costing method that focuses on making the best use of the bottleneck. Now, what is bottleneck here? Yeah, Aditi, what is bottleneck? It's the scarce resource. So they make sure that they utilize the scarce resources very strategically and they try to maximize their profits. In the short term, even your direct labor cost, sorry, in the short term, even your direct material cost is variable. In the short term, only your direct material cost is considered variable. Only, right? Direct labor is considered fixed. That is one change as well, right? Your direct is considered fixed. So what is throughput? You focus on the bottleneck and try to maximize that. Second, short-term optimization. You make sure the best resource optimization. You're doing variable cost in the short term. Only direct material is variable, right? And labor cost. The direct labor is treated as a fixed cost because employees are usually paid salary or wages, right? Employees are usually paid salary or wages. So direct labor is considered as a fixed cost as well. Right? Throughput is equal to contribution. It's similar to contribution. How do we get contribution, guys? Anybody? Sales minus variable cost. It's similar to contribution, only that even you deduct the direct material deducted from sales. Okay, so sales revenue minus direct material cost. The throughput formula is your sales revenue minus your direct material cost. You'll get your throughput, right? Sales minus direct revenue. So what is throughput? You try to focus on the bottleneck as much as you can and try to make the most out of the resources of the company to maximize profit. And in the short term, you consider only material as the variable cost. Everything else is a fixed cost in the short term. The formula that we look into here is that your sales revenue minus your direct material is your throughput, right? You take your sales revenue minus your direct material cost is your throughput. right? There are three goals of throughput accounting. The three goals over here, as you can see. Firstly, is increase the money generated from sales by using the bottleneck as effectively as possible. Minimize the fixed operating costs like salaries, rent, and utilities. Keep the inventory as low, so very less money is is tied up in unused stock. Okay, so let's go through the three goals here quickly, Monisha. What are the three goals for throughput accounting? What is throughput? Sales revenue minus direct material cost. Okay, so maximize the throughput. Next. Now, okay. Utilities. Yeah, and they don't have too much money tied up in unused stock, right? Their money, because you buy stock, you have to pay for it, right? So you don't have too much money tied up in unused stock. So there are the three goals. So firstly, we understood throughput. You identify the bottleneck and try to maximize it. Throughput is nothing but here in this case, direct material is still considered as a only direct material is considered as a variable cost. So what you do is you type sales minus variable cost, like we calculate contribution. Here you do sales minus direct material cost, you'll get your throughput. And one of your goal is to reduce the throughput as low as possible. Okay. So now we'll focus on the bottlenecks. What really we mean by bottlenecks here, and the bottleneck strategies. So firstly, the stage with the lowest capacity that restricts the total output. So bottlenecks is basically it's the stage with the lowest capacity that restricts your total output. An assembly machine can process only 100 units per day, while other department can process 200 units. Right. So what is your throughput over here? That is your the bottleneck over here is your limitation. So the stage with the lowest capacity that restricts the total output. Right. The stage with the lowest capacity that restricts total output. That is your bottleneck. Three types over here: short term, long term, highway bottleneck. Okay, short term, long term, if we focus and we look into an analogy here, short term bottleneck makes the best possible use of the bottleneck without increasing capacity. Long term increases the capacity by investing in more resources. So in the long term, so the narrowest point limits the flow of the entire system. A 3-lane traffic slows because one bridge has only one lane. As a result of that, there is the traffic increase. Okay, but yeah. So how it's working about here is that what about bottleneck here? It means that basically it's the constraint that basically restricts your output. It's a constraint that restricts your output. The constraint that restricts your output is called bottleneck. So there's two strategies here, short term and long term. In short term, what you do, you make the best possible use of the bottleneck without increasing the capacity. In the long term, you just increase the capacity. Right? What do you do? In the long term, you just increase the capacity. Okay. That is just an analogy to help you guys understand. But again, it's just complicating the process. A similar, easier one is to think about it that in the short term and in the long term, what is happening is in the long term, you're purchasing another machine. In the short term, you're ensuring that the machine never remains idle, but you're not investing in a new machine. In the long term, you get a new machine. But in the short term, what you ensure that the new machine never remains idle. You keep utilizing it all the time, right? So you perform and you execute despite the constraint. You try to make the best utilization, keeping the constraint in mind, but not investing in additional resources. In the long term, you invest in additional resources to get over the bottleneck, right? In one case, you make sure that you never remain idle, and in the other time, you take some time and then you invest in an additional resource. You invest in an additional resource. You get more machines to increase production capacity. In the second case, what do? You ensure that the the machine never remains, bottleneck machine never remains idle. That there is a bottleneck. What is bottleneck? Bottleneck basically a constraint that is causing the overall output to come down, and the stage with the lowest capacity that restricts your total output, that is called as the bottleneck stage, right? This is basically totally restricted your output. So what you do is you either make a short-term strategy that you will never keep the bottleneck machine idle at all. You will make the best possible utilization of the bottleneck without increasing capacity. But in the long term, you will increase capacity. That's it. Yeah, so let's make sense of this here, Monisha. When are you increasing capacity? When are you letting it be, but making the best utilization? Perfect. In the long term, we are increasing the capacity. In the short term, we are making the best possible use, but without increasing capacity. And what is bottleneck? Again, it's the restriction or anything that is causing a certain decrease or restriction on the output. Okay, any restriction on the output. That is called as a bottleneck. Okay. Short term, long term. Short term, you are not increasing capacity. Long term, you are increasing capacity. Next, pretty much, we look into the theory of constraints. What about the theory of constraints? Okay. Looking into the theory of constraints, a management approach that identifies and removes the bottleneck to improve the overall performance. So, theory of constraint is removing the bottleneck only. A manufacturer improves the slowest production department first instead of all the departments. So, you're directly attacking and you're trying to improve on the constraints. So, first, what you do, identify it. Second, you exploit it. Third, you subordinate everything else. Fourth, elevate. Fifth, repeat. Okay, so we'll have this case study as well. But first, we identify the bottleneck. First stage is you identify the bottleneck. What is really not working? An assembly can produce only 10,000 units while other department produces more. Okay, so that's your bottleneck. You identified it. Second, you exploit the bottleneck. You avoid machine breakdowns and you reduce the setup time on the bottleneck machine. You ensure that the bottlenecks works as efficiently as possible. Right? You maximize on the bottleneck machine. So if there's one machine that is slow overall, slowing you down, you ensure that it works as efficiently as possible. Can I say this is the short term? This is the short term strategy. Then in the short term strategy, what are you doing? You're making it work as efficiently as possible. Right? Next, subordinate everything else. Other department produce only what the bottleneck can handle. Right? Align all other activities to support the bottleneck. Right? You're totally giving the support to the bottleneck here. You ensure that all other departments are also producing only what the bottleneck can handle. You make sure that there is no other problem to the bottleneck from any other departments as well. Next, elevate the bottleneck. In the long term, you're increasing the bottleneck capacity. Okay, and finally, you're repeating the process. So in the short term, you try to maximize it. Long term, you're just increasing the capacity. Same thing over here. Just a 5-step process, literally the same thing. First, you identify the bottleneck. Next, you exploit it. Exploit it in the short term. It's never idle. Use it as much as can within its capacity. Use as much as you can. Next, you align all the other activities of the business also just to make sure that you are able to give the bottleneck what it needs and not going over and beyond what its current capacity is. In the long term, elevate it. Increase the capacity and repeat the process. Okay. In the long term, what you do is you just repeat the process. Okay. In the long term, what you do is you just repeat the process. So we have an analogy here. Which we look into. Okay. So red sneakers case study. So basically there's a material preparation capacity. So material selection is not the bottleneck because demand is slower than its capacity. So you can prepare how much? 15,000 units per month. Okay. 15,000 units you can prepare per month. This department limits the total production and is the bottleneck. So what it does, this can only assemble 10,000 per unit. Everyone is doing 15, this is only doing 10. Okay, and packaging has spare capacity because only 10,000 units reach it. So it can package around 20,000 per unit. Okay, per month. Market demand, market is 13,000. The company could sell 13,000 pair, but only produces 10,000 due to the bottleneck. So what you're doing is first you're identifying the bottleneck. It is that one department. So first you understood there is an assembly capacity, there's a packaging capacity. Okay, there are two capacities. One is the material preparation, 15,000, assembly capacity, 10,000, packaging capacity, 20,000. These are your first three capacities. First you identified that where is the bottleneck really. No problem in material preparation capacity, no bottleneck there. Packaging also no bottleneck pretty much. But assembly there's a bottleneck there. This is basically limiting your issue. This is that player in the team which is limiting the team's performance. Is assembly, right? Is the assembly department. So first you identify the bottleneck. Right, so assembly department 10,000 is your bottleneck. Did we identify that first? Right, we have three departments. One is the assembly, one is the packaging, one is the material preparation. In that, who is our weak player in this case? Assembly capacity. So first we identified the weak player. Okay, done, easy. We identified the weak player first. We identified the weak player first. Next, capacity, exploit the bottleneck. Then if the machine is limited, produce premium sneakers before budget sneakers because they generate higher throughput. So what you do is, as much as you can maximize, what you started to do, you started making 10,000 only premium sneakers, right? You went totally 10,000 only premium sneakers, right? You ensure all other departments support the bottleneck. So material preparation, only enough parts for the assembly department can process, right? You're subordinating everything else. Next, what you're doing? You are buying an additional machine. In the long term, finally, you increase the capacity through investment. Right? And finally, only one bottleneck is removed. Identify the next bottleneck and repeat the process. Okay? Identify the next bottleneck and then repeat the process. So first you found out the bottleneck. Who was the bottleneck? It was the assembly. That was the bottleneck. So what you did now, you try to maximize the bottleneck and align all the other activities of all the other departments just to make sure that the bottleneck is the machine with the bottleneck is at its maximum potential. You're doing the best as it can. Finally, as time passes by, in the long term, you increase the capacity and then you follow the same process for all other bottlenecks. This is just for one bottleneck. Okay. So identify the system's bottleneck. Second, you exploit the bottleneck, right? This step requires ensuring we identify how to use the limited resources to the best of its potential. Step 3, subordinate everything else. All the other activities of all the departments you are aligning in such a way that directly attack to this particular bottleneck. Then you elevate the system bottleneck by getting an additional machine, and then you repeat the process. Okay, finally you just repeat the process, right? What you do is you finally just repeat the process. Right? And this is an ongoing process. Okay, this is an ongoing process of finding and removing constraint. Then you find the new bottleneck. Okay. So that is pretty much how it goes. That first you identify the bottleneck. Second, in the short term, make it as efficient as possible. Align all the other activities. In the long term, increase the capacity. Fifth, repeat the process. That's it. So it's all about us first identifying it, then using it to the best of its capacity, aligning everything else just for that this can be utilized at the best capacity, and then increasing the capacity in the long term, and then finally looking for the next bottleneck. Okay, so then we have the throughput accounting ratio. Next thing is the throughput accounting ratio. What about the throughput accounting ratio? It's a ratio that measures whether a product generates enough throughput to cover the operating cost or not. Right? It makes sure, what is throughput again? Sales minus direct material cost. Yeah. So it just ensures that a ratio that measures whether a product is generating enough throughput to cover your factory operating cost. Is it generating enough throughput to cover your factory operating cost? Okay. Is it generating enough throughput to increase your factory operating cost? Is it generating enough throughput? Is it not? Is it not? That is your throughput accounting ratio. Is it generating enough output? Okay. For your capacity, generating whether a product generates enough throughput to cover your factory operating costs, right? Are you generating enough throughput to cover your factory operating cost? That is your throughput accounting ratio. That is your nothing but throughput accounting ratio. Are you generating enough? The question is, are you generating enough? Are you generating enough? Yeah, are you generating enough throughput accounting ratio to cover your factory operating costs? Okay. What do the numbers mean? Right? If your throughput is greater than 1, your product is profitable. If your throughput is less than 1, your product is not unprofitable, right? You take your return per factory hour divided by cost per factory hour, okay? Return per factory hour, cost per factory hour, right? Return per factory hour, cost per factory hour. If it's greater than 1, then your product is profitable. If not, your product is not profitable, right? It has to be greater than 1, okay? So return per factory hour, cost per factory hour, okay? So these are the two things that you have just picked up. Right? Return per factory hour, cost per factory hour. If it's greater than 1, then it's good. Less than 1, it's not so good. Your product is profitable if it's greater than 1. If it's less than 1, it's not really that profitable. Okay? Not very profitable beyond that. Right? It's not really very profitable. Is it greater than 1? Is it less than 1? Right? So choose the products with the highest TPAR. Right? Whichever products have the highest, just go for that. Right? Go for the one that has the highest. Okay, go for the one that has the highest TPAR, right? So just make sure go for the product that has the highest TPAR. Okay, so what have we picked up here? The accounting ratio and understanding and calculating it, right? If it's greater than 1, go for it. Less than 1, don't go for it. Greater than 1 means it's a profitable product. Less than 1, unprofitable product. Focus on the cost per factory hour, return per factory hour, return per factory hour. Okay, we look into all these numbers here, but just high level you need to understand, is it greater than 1, is it less than 1? If it's greater than 1, there is a improvement, it's less than 1, then there is a problem here, you have to reconsider your decisions. So the question is it greater, is it less than 1? Okay, so first of all, what is throughput? It's your sales minus direct material cost. Next, what you do, you identify the bottleneck, and then you do the best in the short term, in the long term you replace it. Then you make sure that you follow the process pretty much. Next, your throughput ratio here, we understood what is the throughput ratio. That it measures whether a product generates enough to cover the factory operating cost. If it does, great. If it doesn't, then it's unprofitable. We have some examples with regard to return per factory hour, cost per factory hour. Okay, so we can look into some examples, but pretty much you need to understand what does throughput really mean. right? It measures whether a product generates enough to cover your factory operating cost or not. If it's greater than 1, it does. If it's not greater than 1, to be honest, it doesn't. Okay. Okay. Making sense of the example here, throughput accounting ratio. Okay. Okay. So now, for example, two products are there. One has a TPAR, throughput accounting ratio of 2. The other has a throughput accounting ratio of 1.4. Okay. So what you have to do, choose with the highest TPAR. What you have to do, choose it with the highest TPAR. So first of all, we understood the one which has highest TPAR is the better. Now let's look into making sense of TPAR here. Okay, a business manufactures a single product that it sells for 10 per unit. So the selling price is 10, the revenue is 10, material cost is variable is 3. So can I say my throughput is 7? Yeah, selling price minus your direct material cost. The total operating expenses are 50,000 each month. This is your operating expenses. And if we have to make sure that our throughput is greater than our operating expenses, right? If our throughput is not greater than our operating expenses, then it's a problem. So your total operating expenses are 50,000 each month. Labor hours are limited to 20,000. So this is the limitation, right? This is your limitation, 20,000 hours each month. And each unit of the product take 2 hours to assemble. Each unit of the product take 2 hours to assemble. Okay, so firstly what we'll do, we'll calculate the throughput per factory hour. So 10 minus 3, 7 we understood per factory hour and the amount of time it takes per unit. So first of all we calculate throughput per unit, then we calculate time per unit. So we got the throughput per factory hour, 3.50. Then we calculated the cost per factory hour. So 50,000 is your expenses, 20,000 is available. So your throughput is 2.50. Okay, then calculate your throughput. Return per factory hour 3.50, cost per factory hour 2.50. Then you divide the two and you're getting something that's greater than 1. And since you're getting greater than 1, it indicates that it's a profitable operation. Right? So calculate throughput per factory hour and then cost per factory hour and then divide the two. What you're doing throughput per factory hour. Let's calculate the throughput first. Did you make sense of 10 minus 3, 7? Yeah. Then we're looking into the time per unit, how much it takes. So we got 3.50. Is that clear? Next, cost per unit, we take total operating cost 50,000 divided by the hours available. So you get 2.50, that is your cost per factory hour. So we found the throughput, we found the cost. And then we divided the throughput and the cost. And when we divided the throughput and the cost, and if a number is greater than 1, then it's good. If it's less than 1, then it's not so good. In this case, it's greater than 1, so we are good to go. Yeah, greater than 1, we are good to go. And if it's greater than 1, it's a profitable project. So basically, a throughput should be greater than cost. So cost always in the denominator. Cost always in the denominator. That's it. Throughput in the numerator, cost in the denominator. Overall ratio is greater than 1, then profitable. Less than 1, not profitable. Okay. Always make sure that your cost is down. Then only something greater than 1 will make sense. Throughput on top. Only if throughput is greater than 1, then it's perfect. That's it. Okay. So we calculate the throughput, we divide by the unit, then we took the cost, divided by the units, we got the unit value for both, divided the two, we got the answer, done, finished. TPAR. Okay, clear with this now, Aditi?
Yes.
Okay, something that is better explained numerically. Next, how can you reduce your TPAR? Okay, so see, basically you want to improve it. So what you can do? Increase your direct material, increase your sales price, reduce the direct material cost. So basically, see, how do you get your TPAR? Sales price minus direct material. So if you increase the sales price, don't you think TPAR will automatically go up? Or if you reduce the direct material cost, TPAR will already go up. There are only two elements. One is subtracted from the other. Either reduce the subtraction or increase the first amount. Okay? Increase the subtraction or reduce the first amount. That's it, done. Next, reduce the operating expenses. Okay, next we'll look into is reducing the operating expenses. Okay, reduce the operating expenses. What about this? Okay, reduce the operating expenses. Okay, so increase the sales price or reduce the material cost. Reduce your operating expenses, improve productivity. These are 4 ways you can pretty much improve your TPAR. If you want to improve your TPAR, this is what you can do. Increase your sales price, reduce your material cost. This is pretty straightforward. Lower the factory cost, to reduce the cost per factory hour. Reduce the cost per factory hour and improve the productivity. And if you do these four, overall your TPR will improve. Okay, there's an improvement example here. So before it was that, after it was this. So you see, before the return was 3.50, after the return was 86. Right? Before the cost was 2.50, cost is 2.25. TPR was 1.40, it become 2.67. Right? Because of the certain changes you made, what changes you made? Your operating expenses fell from 50,000 to 45,000. The moment your expenses fell, you realize your TPR improved. Yeah? It fell, your TPR improved. 52.45, your TPR improved. Easy, done, finished. Okay, good with this? Okay, now we're moving into TPR example is done. Yeah, okay, so that you've improved and then you see there's an improvement that has happened.